Good morning, good afternoon, and good evening. I'm Keesa Schreane, and welcome to the Refinitiv Perspectives live stream. Sustainable funds and investments focused on environmental, social, or governance themes brought in $20.6 billion of new money in 2019. Environmental, social, and governance, or ESG as it's known, has continued to grow as a key theme in our markets throughout 2020. Now, have investments in ESG largely withstood the shock of the impact of coronavirus? And can investors expect that to continue? To share insights on this, we have Global Head of ESG at Refinitiv, Elena Philipova. Elena, thank you so much for joining us.
Thank you, Keesa, for having me.
Great. So, Elena, there was an insightful article in The Economist this week discussing why ESG funds have performed so well. And one theory was that large corporations have more resources. They have greater access when it comes to disclosing relevant data, so they tend to perform better on those ESG scoring systems because of those resources. Now, Elena, is that just one part of the overall performance story? And is there another impetus for such positive ESG performance?
Yes, Keesa, indeed, large cap companies do have access to more resources and tend to have more complete ESG disclosure. However, there are many small cap ESG leaders as well across different industries. So I would actually argue it's not simply a matter of volumes when reporting on corporate ESG strategies and performance, but rather it's about quality, ensuring that the resources and efforts are targeted at the matters that actually are most material to the industries and the individual businesses. I do think that the main reason for the better performance of ESG companies and portfolios in the time of crisis, like the one we're right now, is sustainable businesses are simply quality investments. They have corporate culture of compliance, of integrity, and transparency in business reporting. So they are strong in terms of their corporate governance structures and practices, and they do serve the needs of all stakeholder groups rather than just maximizing shareholder value. So therefore, they are more resilient and they recover quicker from crisis.
So you mentioned the resiliency of these funds and the strength. We also know that sustainable investing is one way institutional investors mitigate risk. But with COVID-19 hitting so many industries, how are sustainable investments actually performing better than other investments that don't have an ESG component in this environment?
Yes, indeed, what we're facing right now is the worst economic crisis since the Great Depression in the 1930s, which will leave no one industry the same and is giving humanity an important lesson, which I would like to talk more about later in today's session. But specifically to your question, the economic crisis is also giving us an opportunity to put some ESG hypotheses to the test. Firstly, are good ESG companies and portfolios less volatile during bear markets? And secondly, are asset owners demanding sustainable solutions only when they can afford them in bull markets? And clearly, there are many contributing factors, but so far, market studies and research analysis done so far on the performance since COVID crisis started have been very consistent in their findings. That is that ESG companies and portfolios have been simply more resilient. And that's true for indices where ESG indices perform better than benchmarks, conventional benchmarks. It's also true for ESG funds, as already mentioned, which outperform the peer funds on relevant technical indicators. Good ESG companies outperform the market, and also they have smaller earnings per share cuts. In a recent study that I came across, it was concluded that the top 20% of ESG ranked stocks in the US performed the US market by over 5% during the recent sell-off. And this outperformance also persists on a sector-adjusted basis. So those are quite conclusive findings, which are good to reference to. In terms of outflows, We've seen that ESG ETFs had lower outflows for both equities and fixed income and are still net positive year to date compared to the record outflows from equities overall. So the initial indicators are signaling that ESG does equal to more resilience, and both hypotheses hold true so far. However, it will be important to continue this analysis over the next quarter or two to have more solid results and conclusions.
And it looks like, Elena, that the popular sentiment right now is in agreement with that in terms of better performance, lower outflows. According to a Deloitte Insights report, ESG mandated assets could make up half of all mandated assets in the US by 2025. But wondering if investors expect with stock market swings in our future, more pandemics, more natural disasters, and other similarly challenging market events. Can we expect that ESG growth will continue to accelerate, or might there be reason to worry about deceleration?
Mm-hmm. Yeah, I mean, the current pandemic crisis has certainly changed the whole world. And this will demand an immediate behavioral change where sustainability is the new norm, the core of everyday decisions that we make as citizens, as consumers, as investors, and as corporate executives. I do believe that the current crisis will accelerate the growth of ESG mandated assets. And I think that the reasons for that are very simple. As mentioned, good sustainable businesses are quality investments. They are more resilient and better prepared to recover after crisis. And I cannot imagine any investor consciously avoiding high quality investments. I think the main question right now is more around awareness, education, and breaking old habits.
Okay. And let's take a step back a bit. We know that there was a huge focus on climate change in Davos in January. You were talking about breaking old habits. And at that particular time, there really seemed to be a lot of public sentiment that really shifted toward looking for solutions and really breaking those old habits that had been laid out in the past, much more public sentiment. Then the pandemic hit. So is there a way for that climate change discussion to be revived in the light of COVID-19? Or do you think we'll just go back to, as you say, those old habits, those old ways of thinking pre-COVID-19, even pre-Davos 2020? What are your thoughts there?
I do think it's very important that we all understand the close connection between the two topics, climate change and pandemics. There is a broad scientific consensus that the threat of pandemic diseases on human well-being and economic development, of course, as we see it, is linked to climate change, biodiversity loss, and deforestation. This pandemic has proved us how closely our fate and our prosperity is linked to the health of the natural world. And right now, our relationship with nature is broken. We've cut down forests and expanded our cities in such a rapid pace, destroying countless natural habitats. And at the same time, trading wildlife, common and endangered, across the world as if it's a commodity. All of this is actually bringing us, human beings, closer and more frequently in contact with viruses that can spread from animals to people, including the COVID-19 coronavirus, but also dozens of other deadly illnesses. So the connection is very strong, but there is good news. And the good news is that more and more political leaders, as well as international organizations, are already formulating sustainable regulation and action plans that could help minimize the risk, severity, and frequency of pandemics. Not eliminate those risks, but really minimize and broaden them around to make sure that we're more resilient and more prepared as and when future crises reach us. And as the world moves towards recovery from the current pandemic, we do need to ensure that we finance a just and green recovery. Clearly, governments are faced with critical questions around how to best use limited public funds to ensure both socially just as well as green recovery. But the power of the private funds is most important here. And capital allocation decisions must align with the future that we all want to finance.
And so two really incredible points there. Number one, you mentioned this pandemic, which lets us understand that there have been quite a few before this, and also the separate piece of really bringing funding to support solutions here. Back in 2017, the World Bank launched the first pandemic bonds. And back then, the focus was to provide funding to developing countries facing pandemic risks. Fast forward to today, Elena, as you said, right now there is a surge in solutions around that. There's a surge in types of bonds that can really help these situations. Countries are issuing COVID-19 sovereign bonds, or pandemic sovereign bonds, as they're called also. How long can investors expect the trend around launches of these COVID-19 bonds? Or do you expect to see more generic pandemic bonds in the future?
Yes, you're correct, Keesa. We've seen a recent rush in social and sustainable bonds issuance as both companies as well as governments issued debt in an attempt to ease the effect of the coronavirus pandemic. And we do expect this trend to continue, given the current environment and prediction of how long it will continue. It's also interesting to compare this year's issuance to last year's issuance. We do see a steady upward trajectory in the data. For the combined ESG bond sector covered by Refinitiv, for last year, we had around 233 billion in the whole of last year. Equating this to year to date, it's about 76 billion. And this compares to over 115 billion so far in 2020. In terms of social bond issuance last year, there was a little over 13 billion in issuance throughout the whole year. And so far in 2020, it is 23 billion. And in total of those 23 billion, about 18 are labeled as coronavirus support issuance. So we will continue seeing these issuance as well as the expansion of ESG and sustainable bonds being utilized by companies and governments in the foreseeable future.
Very much needed with pandemics, the one we have now and what we can expect to see in the future, to your point. We'll be opening up to questions from the audience shortly, so please get those questions ready for us. Meantime, Elena, with so many companies struggling financially right now, what are sustainable companies focusing on in this time of financial uncertainty?
Yes, I do believe that we all, humans and businesses, are given a very unique opportunity to rethink and rebuild for a more sustainable and resilient social model, financial markets, as well as business structures. In recent years, what we've seen is that more corporate executives are starting to integrate sustainability inside, not just beside the business. And that's really important. Not only is this important, but continuing and accelerating those shifts in the business world are more critical than ever. And more importantly, such companies are also delivering financial outperformance as a result of those structural changes and the alignment of corporate purpose together with profits. New business leaders are making such genuine fundamental commitments to all stakeholders, and they are prepared better and are more resilient during this as well as future social and environmental crises. Earlier this year, Refinitiv published a report on governance and sustainability, and as presented there, greater transparency leads to greater accountability, and thus better performance, not only ESG performance, but also financial performance. And I do hope and expect that businesses will be pressured by stakeholders to quickly adapt and adopt more sustainable business practices and models and be transparent about it. Because let's face it, any corporate transformation has to start with the top. Sustainable companies have moved away from short-termism in decision-making, like laying off employees during time of crisis, to more long-term thinking and sustainability truly incorporated into everyday decisions. And that's what distinguishes them. That's what differentiates them.
So in talking about transparency and in its most generic context, let's talk about the changes that you're seeing and that you are making around ESG scoring and transparency of data. What do those changes mean for investors and what are they?
That's correct, Keesa. So we recently introduced a series of enhancements to the Refinitiv ESG scoring methodology, and the feedback so far has been overwhelmingly positive. The Refinitiv ESG scores are designed to transparently and objectively measure a company's relative ESG performance, commitments, and effectiveness across all ESG teams based on publicly available auditable data. Our scoring methodology has been enhanced to include three primary enhancements, which we believe are critical to reflect the evolution in the sustainable finance industry that we've seen. The first enhancement is the introduction of an objective approach to materiality. Materiality is critically important in understanding relevant topics across the full spectrum of ESG issues that impact individual companies in a material way. For us, it is critically important to build the data and the analytics in a very objective way, which is a big challenge in a space like sustainability. But an innovative materiality model that we've adopted does exactly that. The second enhancement is around company size bias adjustments. And we do believe that this is very important because in ESG, there are different company size biases, as we already discussed at the beginning of the session. And the third enhancement is around transparency stimulation. Again, we touched on the importance of corporate transparency. And this point is especially important as ESG disclosure becomes the norm. Companies that do not report are simply no longer given an easy pass. For investors, what those enhancements mean are great improvements, but namely, they offer more accurate assessment of the ESG risks and opportunities in their portfolios. They offer greater incentives to put pressures on companies to manage better their material ESG risks and report on them, importantly. And then a great confidence in the achievement of the desired positive impacts that sometimes lie behind sustainable strategies.
Thank you for that, Elena. I want to jump to our questions from the live stream audience. We have a few of them. First question, should people be more concerned about the company level ESG scores or the industry level? For example, if a company has a high ESG score, but the sector it operates in has a low score, which is most important?
Mm-hmm. I mean, obviously investors will develop different strategies and choose which one meets their objectives best. We do see customers that would like to identify and support with capital allocation the ESG leaders across all industries, regardless of how good from a sustainable perspective they are. And there are merits for different strategies, of course. We serve sustainable investors that are very thematically oriented, and they will avoid investing in certain industries and activities. So it's important to make sure that they can rely on trusted, auditable information that will empower their strategies regardless of what they are.
Great. Next question, ESG finds on the equity side usually holds companies like Apple, Visa, Facebook, JPM, which always falls on one or another parameter of ESG. They want to know, wouldn't this dilute the whole purpose of ESG investing?
That's absolutely right. That some companies are favorite targets for media and controversies and will simply attract more attention. This is one of the main reasons we also introduced the company size adjustment factor into the Refinitiv ESG scoring methodology to factor in exactly that same problem, where large cap companies, namely in some sectors and some industries, will simply attract a lot of attention versus smaller cap companies that will not make the headlines. So it is a matter of acknowledging the dynamics around ESG and ESG data and adjusting the aspects of those dynamics to align with the philosophy and the investment objectives that you're pursuing.
Next question from the live stream. What are the actual examples of how we measure G and S in ESG? The examples of actions that companies should take to increase their scores, maybe some examples from the COVID-19 response.
Mm-hmm. I mean, in social is a really great example to talk about, and it is something that potentially has been given less airtime and less attention historically, but with the COVID crisis, that has completely changed. And we already touched on one example: workforce relations, caring for your employees, offering flexible working hours, as well as flexibility and work from home arrangements. Not jumping straight on laying off employees because it's the easiest way to solve your immediate liquidity problem. This, of course, is going to create a lot of problems and arguably higher costs for the business in the long run. That's one example. Of course, under the social umbrella, there are other aspects around human rights, supply chain, child labor, forced labor, relationships with the community and the wider public where businesses operate. So there are lots of examples, and individual businesses have the different reach and opportunity to leverage their expertise and assets to make meaningful contributions in the areas that matter to them. From a governance point of view, there is a lot written on this topic, and we do believe that corporate governance best practices are well documented, as well as there is high degree of consistency and standardization in those recommendations and standards. Things like independence on the board and diversity, as well as diversity of experience, as well as diversity of backgrounds and opinions that would be brought onto the board table for discussions is one aspect. Treatment of shareholders and equal treatment of minority shareholders is also part of the broader umbrella of best governance practices, as well as putting safeguards in place and procedures to protect minority shareholders in case of takeover attempts, hostile takeover attempts.
Great. Thank you for that, Elena. We're going to try to get just a few more questions in the next 6 or 7 minutes or so. This next question, could you please share your view on the idea stated in academic papers recently that yet another focus on the E component of ESG could be influencing the company's development strategies in order to convince GAs and executive boards to improve ESG ratings rather than just excluding such issuers from the screening if they don't satisfy certain thresholds?
I mean, as mentioned, I do believe that it's very important to encourage and not limit innovation and flexibility that we see in the market. And there is a variety of investment strategies that would fall under the sustainable umbrella. Avoiding investing in fossil fuel, for example, is certainly one strategy, but you do have quite a large number of sustainable investors out there that would invest in this industry and sector, but simply, for example, reduce the allocation and increase the allocation to other sectors. So there are different ways. I think it's very important to understand that sustainable investing doesn't mean limiting yourself and limiting your diversification and exposure to industries and markets. Rather, it's about making conscious decisions about how can you preserve and continue have the financial objectives that you pursue, and at the same time improve your positive impact across the chosen environmental or social issues and areas. As well as many investors view ESG investing as a valuation strategy. There are certain topics and issues which investors believe will have a material impact on the value of companies that they invest in, and therefore account for the value in the valuation as well as their risk management, and make respective choices. Well, it doesn't need to be divestment only. There are investors that are really effective in engaging with companies that are exposed to ESG risks. And through the engagement practices, some argue you're able to deliver the greatest impact because you're changing the worst company, so to say.
Impactful. What data points apart from the governance does an investor look for while analyzing the E and the S component for financial firms, so banks and insurance and the like?
Obviously for the financial sector, there are different metrics that are material. If we think about climate change for the banking sector, the biggest impact would be through Scope 3 emissions, which is through the investments in holdings that such companies are making. So it's a different way to analyze the impacts as well as the opportunities for greater impact for this sector versus some of the other sectors.
Okay. And our last question, how can the banking system be more concerned with ESG investing?
Well, what we've seen is that the banking system is certainly starting to get quite concerned with ESG and sustainability, as well as realizing the risks that are presented to their portfolios and the huge opportunities that sustainable investing is actually creating for not only the banking sector, but for every industry across the whole economy.
Elena, thank you for such a great discussion, ranging from the importance of financial materiality, the value, and also the social piece of it. Elena Philipova, thank you for such insight.
Thank you, Keesa.
And we want to thank everyone for participating. And if you've enjoyed today's live stream, click on our upcoming webinar. Check out our upcoming webinar by clicking on the below. It's on May 21st. We'll have a panel of experts who'll be talking about ESG developer data and methodologies. Again, register for it by typing the address or scanning the QR code shown on the screen now. Everyone, thank you so much for joining. I'm Keesa Schreane. Have a fantastic day and be well.